This is Jessica Dunn, and today we're going to cover Chapter 2. The first item that we will cover concerns taxation. Individuals and businesses have to pay taxes on the income that they receive. The income earned by sole proprietors and partners is taxed at personal income tax rates. Corporate income, however, is subject to corporate taxation. Individuals and businesses can earn two types of income, ordinary and capital gains, and we'll cover those in more depth in a few minutes. Slide 3 of Chapter 2 shows you the corporate tax rate schedule. You will notice that these are equations. So, in order to determine the amount of taxes that a corporation would have to pay, you first determine your taxable income. Once that's determined, you see where your taxable income falls within these ranges. So here are the ranges. Does the taxable income lie between $0 and $50,000, $50,000 and $75,000, $75,000 and $100,000, $100,000 to $335,000, and so on? Once you've determined what range your income falls into, you use the corresponding equations found on the right-hand side of this table. We'll do some examples. So first of all, ordinary income is the income that's earned through the sale of a firm's goods or services. So we have an example. Weber Manufacturing has before-tax earnings of $250,000. So the first step, now that we know how much they're going to be taxed on, so their taxable income in this instance is $250,000. The first step is to determine which equation we're going to use. So $250,000, that's greater than $100,000 and less than $335,000. So we use this corresponding equation. Weber Manufacturing is going to have a base tax of $22,250 plus 39% of any amount over $100,000. So here's our equation. Now we can determine exactly how much Weber Manufacturing will owe in taxes. They have a base tax of $22,250 plus their marginal tax rate is 39% times any amount over $100,000. So they've earned $250,000 and we're going to subtract from that $100,000. If you work this out, you will find that Weber Manufacturing owes $80,750 in taxes. The marginal tax rate is the rate at which additional income is taxed. For the example we just looked at, it was 39%. If I were to ask you what the marginal tax rate is, there aren't any equations that you have to memorize. You simply have to look at the corporate tax rate schedule that will be provided, find the marginal tax rate, and that's the answer. So for Weber, the marginal tax rate is 39%. The average tax rate, however, must be calculated. And you determine the average tax rate by dividing taxes owed by taxable income. So for the previous example, Weber Manufacturing, we can calculate their average tax rate. That's going to be equal to taxes owed, $80,750, divided by taxable income of $250,000. So 32.3%. In most business decisions, it's the marginal tax rate that matters. We want to know what our next dollar of income will be taxed at. The average tax rate matters, but not so much for choosing which projects to invest in. A corporation can deduct interest expense, but it cannot deduct dividend payments. For corporations only, 70% of dividend income received from an investment, so this is an investment for this company. They're going to be receiving a dividend from an external company. 70% of these dividends received, if they own less than 20% of the company, is excluded from taxation. This helps moderate the effect of double taxation. Double taxation occurs when the after-tax corporate earnings are distributed as dividends to shareholders, and the shareholders then take those earnings and they have to pay taxes on the amount that they received as dividends. Unlike dividend income, interest income is fully taxed. When calculating taxes, corporations can deduct operating expenses and interest expense, but not dividends paid. This creates a built-in advantage for using debt financing. And here's an example to show this. We have two companies, debt company and no debt company. Both expect to have earnings before interest and taxes in the coming year of $200,000. During the year, debt company will pay $30,000 in interest expense, and no debt company doesn't have any debt, so they have no interest expense. So we have both companies, debt and no debt company. They both have earnings before interest and taxes of $200,000. From that, we would deduct interest expense. Debt company has interest expense of $30,000, while no debt company has no interest expense. That gives us earnings before taxes, $170,000 for debt company, and $200,000 for no debt company. They now have to pay taxes on these earnings, and we'll say that their tax rate is 40%. So the taxes owed by debt company is 40% times the $170,000 to give you $68,000. For no debt company, it's 40% times $200,000 to give you $80,000. So this gives you earnings after taxes. For debt company, that's $102,000. And for no debt company, that's $120,000. So there's only an $18,000 difference in earnings after taxes. Debt company paid $30,000 more in interest expense than no debt company, but their earnings after taxes are only $18,000 less. That's because the interest expense is tax deductible. So the use of debt financing can increase cash flow and earnings per share and decrease the amount of taxes paid. So the tax deductibility of interest and other certain expenses reduces the actual after-tax cost to a profitable firm. So we've talked about ordinary income. Ordinary income is income that's received from day-to-day operations through the sale of goods and services. The second type of income is capital gains. Capital gains are the amount by which the sale price of an asset exceeds its purchase price. So for example, you as a company purchase some manufacturing equipment for $100,000. 10 years later, you sell it for $105,000. That $5,000 increase is capital gains. For corporations, these capital gains are added to ordinary income and are taxed just like ordinary income at the marginal tax rate. Here's an example. Ross Company earned $120,000 in 2013. During 2013, the company sold for $150,000 an asset that was originally purchased for $125,000. So how much do they owe in taxes? First, we know that ordinary income is equal to $120,000. Capital gains is equal to $150,000 minus $125,000. So they have capital gains of $25,000. So their taxable income is equal to ordinary income plus capital gains. That's $120,000 plus $25,000 to give you $140,000 in taxable income. So now that we know taxable income, we can calculate the amount of taxes owed. $140,000 on the tax rate schedule is greater than $100,000 but less than $335,000. So their equation, the base tax, is $22,250 plus 39% times any amount greater than $100,000. So the taxes owed here, the base tax is $22,250 plus 39% times $140,000 minus $100,000. So Ross Company owes $37,850 in taxes. Their marginal tax rate, to determine that, all we have to do is look at the equation on the corporate tax rate schedule, and you'll see that the marginal tax rate here is 39%. So their next dollar of earnings would be taxed at 39%. The average tax rate is equal to $37,850 divided by their taxable income of $140,000. And that's 27%. Generally accepted accounting principles are the practice and procedure guidelines that are used to prepare and maintain financial records and reports. These are authorized by the Financial Accounting Standards Board. Sarbanes-Oxley of 2002, which is often called SOX, was passed to eliminate the disclosure and conflict of interest problems of corporations. The Public Company Accounting Oversight Board is charged with protecting the interests of investors and furthering the public interest in the preparation of informative, fair, and independent audit reports. Any company that has more than $5 million in assets and more than 500 shareholders are required to report to the SEC. They're required to provide shareholders with the annual stockholders report. This is the 10-K. Remember when we looked at Edgar and we searched for 10Ks and proxy statements to DEF 14As, we found all of this information. The International Financial Reporting Standards are established by the International Accounting Standards Board. 80 countries now require their firms to comply with the International Financial Reporting Standards. The United States, however, require financial results to be reporting using generally accepted accounting principles. These are much more stringent than the International Financial Reporting Standards. So it's difficult to compare international and domestic financial statements simply because the United States public companies are required to follow more strict guidelines. Near the end of every quarter, most companies unveil their quarterly performance. If a firm beats their analyst estimate, they often see their share price jump, while those that don't quite make analyst estimates tend to suffer price declines. The most anticipated performance measure is earnings per share, and this is what's usually compared to the estimates of analysts. So the pitfalls of using reported earnings as a measure of performance. It's easy for managers to mislead investors, sometimes within the generally accepted accounting principles and sometimes not. The process of manipulating earnings to mislead investors is known as earnings management. For example, General Electric beat estimates every quarter for 10 years, from 1995 to 2004. In 2009, the SEC fined General Electric for $50 million for improper accounting practices. So Warren Buffett has some words of wisdom. First, he says, weak visible accounting practices are typically a sign of bigger problems. When you can't understand management, the reason is probably that management doesn't want you to understand them. Investors should be suspicious of projections because earnings and growth do not typically progress in an orderly fashion. Managers that always promise to make the numbers will at some point be tempted to make up the numbers. And you can see this if you were to read very many proxy statements. You would see which companies are being honest and open and those that are trying to conceal things. It's very easy for a company to throw in a lot of legal jargon and to put things in odd order, so it's difficult to find what you're looking for within these statements. And they generally do so because they're trying to hide something. So, a little note about individual taxation. Individuals, they also face progressive tax rates. The rate on long-term capital gains is 15%, but capital gains are only taxed if you sell the asset. Dividends are taxed at the same rate as capital gains, and interest on munis is not subject to federal taxation. So this whole idea of tax-exempt munis, here's an example. Suppose you can purchase $5,000 worth of an investment. ExxonMobil has an expected return of 10%, while a muni has a return of 7%. Which do you buy if your tax rate is 25%? So here, we simply take our expected return multiply it by our dollar investment, and multiply that by 1 minus the tax rate. And that gives you $375. The municipal bond has a return of 7%. They're investing $5,000 into the asset, and it has a tax rate of 0. So the municipal bond in this instance would only return you $350. So at what rate would you be indifferent between the municipal bond and the corporate bond? You simply solve t in this equation. So you solve for t in this equation. The municipal bond is equal to the corporate yield. The municipal bond yield is equal to the corporate yield times 1 minus the tax rate. So the municipal yield was 7%. We set that equal to the corporate yield of 10%. And multiply that by 1 minus t. So if you solve for t here, you'll get 30%. So what does that mean? If your tax rate is greater than 30%, you would buy munis. If your tax rate is less than 30%, buy corporate bonds. So only high income, and by that we mean those in a high tax bracket, should buy municipal bonds. So we're going to cover the income statements, the 4 key financial statements, and we're going to start with the income statement. The income statement provides a financial summary of the company's operating results for a specific period. They are prepared quarterly for reporting purposes, so you can find these on the 10Q on Edgar. But for management, they're usually computed monthly. So again, those are available on the 10Q statements on Edgar. So the income statement, balance sheet, and cash flow statement are interrelated. The income statement is going to describe how assets and liabilities are used during the period. The balance sheet says, where does my business stand today? What do I owe? And what do I own? And the cash flow statement explains the inflows and outflows of cash. So one important way the financial statements are used together is in the calculating of free cash flow. We'll cover this more in depth in a minute, but a lot of free cash flow says that a company is able to pay their debts and their dividends. So first we're going to look at the income statement, which asks, how well did my business do during this period? So the income statement starts with revenue. This is any money paid to suppliers. This is any money that's brought in from the company. So in the sale of goods or services. From that, you deduct expenses. So any money that's paid to suppliers or employees. This includes things such as cost of goods sold or operating expenses. And from that, you subtract depreciation. So depreciation is not a real cash flow. At the end of the month, you're not going to have a check written to depreciation. But this gives you earnings before interest and taxes. From earnings before interest and taxes, you deduct any money that you pay on your debt, so the interest expense. And that leaves you with earnings before taxes. from earnings before taxes, you deduct any taxes. This is money that you owe to the government to give you net income. You deduct dividends paid to preferred shareholders. And that leaves you with the earnings that are available for the common shareholders. So at this point, there is one of two things that can happen with this earnings available to common shareholders. On one side, it could actually be paid to the shareholders. On the other side, it could be reinvested. So here's a good time to show you exactly what we mean by this whole double taxation. So here, corporations earn money and they pay taxes on this money at the corporate tax rate. They then take that money, and if they choose to pay it to shareholders, shareholders are then taxed at the personal income tax rate. So these people up here at the top, they have relatively little risk. So these are cash flows that have a little risk. So it's money that's going to be paid to your employees, to your debt holders, to the government. Down here at the bottom, for common shareholders, this is high risk, but unlimited return. So common shareholders are not promised anything, but they also face losing everything that they've invested within the company. At the same time, however, they have unlimited rewards. From the income statement, you can calculate earnings per share. Earnings per share represents the number of dollars earned during the period on behalf of each share of common stock, and is calculated as earnings available to common shareholders over the number of shares of common stock. Dividends per share, very similar. It's the dollar amount of cash distributed during the period to each share of common stock. And to calculate dividends per share, it's dividends paid to common shareholders divided by the number of shares of common stock. So here's an example of an income statement, which is posted on Canvas, so you can print this out via your PowerPoint slides. But earnings per share is equal to the earnings available to common shareholders, right here at the bottom of the page. It's back on black ink. So that's equal to 221,000. And we divide that by the number of shares of common stock outstanding. And we see in 2012 that was 76,262. To give you earnings per share of $2.90. We could also calculate dividends per share. Dividends paid to common shareholders over the number of shares of common stock. So the second financial statement that we're going to look at is the balance sheet. And this presents a summary of the firm's financial position at a given point in time. The statement balances what a firm owns with what it owes and what was provided by the owners. and it answers the question, where does my business stand today? So this is what a balance sheet looks like. We have assets on the left-hand side and liabilities plus equity on the right-hand side. So on the asset side, we start with the most liquid assets and work down to the least liquid. So at the very top is cash. So to that we would add accounts receivable, and inventory. These make up current assets. Current assets are then added to fixed assets to give you total assets. So current assets are those assets that are expected to be converted to cash within 1 year, whereas fixed assets are long-term, such things as your equipment or your building. So this goes from more liquid so can be converted to cash quicker to less liquid. On the liabilities and equity side, things are listed from short term to long term. So the most short-term liabilities that we have are accounts payable. These are things that we've bought on credit and intend to repay in the near future. To that we can add notes payable, and that gives us current liabilities. Current liabilities are short-term, and they expect to be paid within 1 year. If we add to that our long-term debt, that gives us total liabilities. And once we add in shareholders' equity, we have total liabilities plus equity. These sides must equal one another. So they must be equal to one another. Assets have to equal liabilities plus equity. So here's a picture of a balance sheet. So on the asset side, that's what we're looking at. Cash, obviously everyone knows what that is, but marketable securities are very liquid, short-term investments. These are usually things like T-bills or CDs. Accounts receivable is money owed to the firm by customers on credit sales. Inventories include raw materials, work in process, and finished goods. Fixed assets is the original cost of all fixed assets owned by the firm, so property, plant, and equipment. And depreciation is the total expense recorded for the depreciation of these fixed assets. On the liability and equity side, we start with accounts payable. That's money owed for credit purchases by the firm. Notes payable, these are outstanding short-term loans, usually from commercial banks. Accruals are amounts owed for services for which a bill has not yet been received. So it's money owed but not paid, so such things as salaries. Long-term debt is debt for which payment is not due in the year. Shareholders' equity is the owner's claim on the firm. Preferred stock is the historical proceeds from the sale of preferred stock. Common stock, the main thing of importance here is that common stock has a par value, and you use that to determine the number of shares outstanding. All common stock has a par value. These are usually set very low at $1 or less, because some states have rules that say that your stock cannot trade for less than its par value. So if your stock price were to fall and it was below your par value, that would be illegal. Paid in capital in excess of par in common stock is the proceeds received from the original sale of the common stock in excess of the par value. Retained earnings is the cumulative total return of all earnings that have been retained and reinvested in the firm since inception. So the third statement we're going to look at is the statement of retained earnings. It reconciles net income earned with cash dividends paid with changes in retained earnings. So this company began the year with $1,012 in retained earnings. Profits were $231. Dividends paid were $108. So year-end retained earnings are $1,135. So the net increase for this company is $123. So the net increase in retained earnings is equal to the $1,135 minus the $1,012 to give you $123. The final statement we're going to look at is the statement of cash flows. It's the summary of cash flows over a period of concern. So it reconciles these cash flows with changes in cash and marketable securities. And this statement ties the income statement and previous and current balance sheets. So this statement of cash flows is going to ask, where did our cash come from and how did we use it? So we have our sources of cash flow. And our uses of cash flow. These fall under three separate activities. Our first is profitable operations. So the main way that we receive cash flow is to have a profitable business. The opposite of that is unprofitable business. The second is the sale of long-term assets. The opposite, a use of cash flow, would be the purchase of long-term assets. Another way that a firm can receive money is an equity infusion. So the owner invests money. The opposite of that is a withdrawal by the owner. Another source of cash flow is long-term borrowing. And the opposite of that is the repayment of debt. So these four sources and uses of cash flow fall into three unique activities. So profitable and unprofitable operations are considered operating activities. The purchase and sale of long-term assets are considered investing activities. And finally, numbers 3 and 4, equity infusions and withdrawals, long-term borrowing and repayment, are considered financing activities. So operating activities, cash flows from those, are cash flows that arise from normal operations. Cash flows from investing activities. These are cash flows that arise from activities such as the acquisition or disposition of current and fixed assets. And cash flows from financing activities. These arise from raising or decreasing cash through the issuance or retraction of additional shares or through short-term or long-term debt for companies' operations. And here is a visual of a cash flow statement. So each of these actions are broken down according to their activities. So we can use free cash flow to tie all of these statements together. And free cash flow is the amount of cash available from operations for distribution to all investors. This is the cash available after we've made any necessary investments to support operations. Company value depends upon the amount of free cash flow it can generate. By establishing how much cash a company has once bills are paid, free cash flow is able to cut through the guesstimations involved in reported earnings. It tracks money. Growing free cash flow frequently preludes increased earnings. Companies that experience increased free cash flow, so revenue growth or efficiency improvements or cost reductions, can reward investors tomorrow. So free cash flow is a good measure of value. There are some problems with free cash flow. There's not a regulatory standard for determining free cash flow. And companies can temporarily boost their free cash flow by stretching out payments, tightening payment collection policies, and depleting inventories. There are 5 uses of free cash flow. So the money left over after all necessary payments have been made. The first is to pay interest on debt. Second, to pay principal on debt. Third, pay dividends. Fourth, buy back stock. And fifth, buy non-operating assets. So these can be things such as marketable securities or investments in other companies. So we're going to calculate free cash flow. There are 5 steps. The first step is to calculate net operating profit after tax. We then calculate net operating working capital, which goes into the calculation of net operating capital, which goes into the equation of net investment in operating capital. Then finally we deduct the net investment in operating capital from the net operating profit after tax to give us free cash flow. So if you look at the we will be using the balance sheet and income statements that are available on Canvas for calculating free cash flow for this example. They're in Excel format, but you can print them off. So first we're going to start with calculating net operating profit after tax. And that's calculated as earnings before interest and taxes times 1 minus the tax rate. So if you look at the Computron's income statement, we see earnings before interest and tax in 2010 is $17,440. We multiply that by 1 minus their tax rate, which is given to you between the income statement and the balance sheet, and it's 40%. So that gives us net operating profit after tax for 2010 of $10,464. We can do the same thing for 2009. In 2009, they had earnings before interest and taxes of $209,100. Multiply that by 1 minus the tax rate of 40%. And that gives us $125,460. So if you go back to our table, the second step is to calculate net operating working capital. To do so, we have to be able to determine operating current assets and operating current liabilities. Operating current assets are the current assets needed to support operations. So they include cash, inventory, and receivables. Operating current liabilities are the current liabilities that result as a normal part of operations and include accounts payable and accruals. So we can calculate net operating working capital. So we can do so for 2010. And that's going to be our operating current assets the cash, $7,782, plus accounts receivable. Accounts receivable are $632,160. All of these are found on the balance sheet, plus inventory. Inventory is $1,287,360. And from that, we would deduct our operating current liabilities. Our operating current liabilities equals accounts payable, $324,000, plus accruals. Accruals are $284,960. So this gives us net operating working capital of $1,317,842. So we can do the same thing for 2009. So first we start with our cash, $9,000. Add to that accounts receivable, $351,200. And inventory, $715,200. And we deduct our operating current liabilities, which includes accounts payable of $145,600 and accruals of $136,000. And so that gives us net operating working capital in 2009 of $793,800. The next step is to calculate total net operating capital. A lot of times we just call this operating capital. And it's equal to our net operating working capital plus operating long-term assets. So our operating capital for 2010 is equal to our net operating working capital in 2010 of $1,317,842 plus our net fixed assets. And our fixed assets are plant and equipment, for 2010 is $939,790. That gives us $2,257,632. So we can do the same thing for 2009. In 2009, we had net operating working capital of $793,800. And we have net plant and equipment of $344,800. So that gives us $1,138,600 in operating capital for 2009. So the final step is to get the net investment in operating capital, which is just the change in operating capital from one year to the next. So the net investment in operating capital is equal to our current year $2,257,632 minus the 2009 $1,138,600 to give us our net investment in operating capital of $1,119,032. So now we have all of the inputs necessary to calculate free cash flow. So free cash flow, we have to take our net operating profit after tax, that was $10,464, and subtract our net investment in operating capital, $1,119,032. So free cash flow is negative $1,108,568. So our free cash flow is negative. Is this good or bad? It's bad if it extends for multiple years in a row, but it's not detrimental. It means that the company is trying to grow. So this company, they did borrow some money. So they're trying to grow the company. So the uses of free cash flow, we can make interest payments, we can reduce or increase our debt, we can pay dividends, repurchase or issue stock, and we can purchase or sell short-term investments. And this gives our uses of free cash flow. So how well a company utilizes the capital invested in the business is the return on invested capital, and it's equal to the net operating profit after tax over operating capital. So we can do this for our company. Our return on invested capital for 2010 is equal to our net operating profit after tax, the $10,464, divided by our operating capital of $2,257,632. And that's 0.5%. We can do the same thing for 2009, and you'll get 11%. So if the firm's cost of capital is 10%, which is what the Excel statement says, it says the weighted average cost of capital is 10%. Did this growth, the negative free cash flow, did it add value to the firm? And the answer would be no. That's because this return on invested capital is 0.5%, and it's less than the return that the investors require of 10%. But high growth usually does cause negative free cash flow due to the investment in capital, but that's okay only if the return on invested capital is greater than the weighted average cost of capital. Economic value added is the value added to shareholders by management. It measures the effects of managerial actions during a given year. And you can calculate economic value added as the net operating profit after tax minus the weighted average cost of capital times capital. So we can calculate economic value added for both 2009 and 2010. So economic value added for 2010 is equal to our net operating profit after tax, $10,464, minus our weighted average cost of capital of 10%, times our capital, the $2,257,632. These are all numbers that we calculated when calculating free cash flow. So when I say capital here, we're talking about operating capital. When you multiply this out and subtract, you get the economic value added for 2010 is a negative number. It's a negative $215,299. We can do the same thing for 2009. We had net operating profit after tax of $125,460 minus our 10% cost of capital times operating capital of $1,138,600. And that gives you economic value added of $11,600. So managerial actions added $11,600 in value to the shareholders in 2009, but managerial actions cost shareholders $215,000 in 2010. So the negative free cash flow was not a good thing. So here we see that the stock price did decline in 2010. Earnings per share declined, and so did dividends per share. A second measure that we can calculate is market value added. Market value added is the market value of equity beyond the book value, and it measures the effects of managerial actions since the inception of the firm. And it's calculated as the market value of the firm minus the book value. So we can do this, we can calculate our market value added. But first we need to calculate the market value of the firm. Here we're assuming the market value of debt equals the book value of debt. So we're only having to look at the changes in equity. So the market value of equity in 2010, we see that there are 100,000 shares outstanding, and they're trading at $6 per share. So the market value of equity is $600,000. And the book value of equity in 2010 is equal to $557,632. You can find this on the the Excel sheet, it's total equity. It's on the right-hand side, the very bottom of the balance sheet. So the market value added for 2010 is the $600,000 minus the $557,632. So managers, since the inception of the firm, had added $42,368 in value. We could do the same thing for 2009. In 2009, the share price was $8.50 and there was 100,000 shares outstanding. And we deduct the equity from that, the $663,768. And we see market value added in 2009 was $186,232. So recent actions for managers have drastically reduced the total amount of value that managers have added since inception. And that's it for Chapter 2. You can find the Excel statements that you need on Canvas.